Okay, when we are done planning and operating variance, just kind of revision to you for planning and operating variance. Now, when we do planning and operating variance, let's assume material. I will have something called as planning variance and operating variance. In planning variance, the headers will be SP into SQ, SP into AQ, AP into AQ. Operating also, it will be SP into SQ, SP into AQ, AP into AQ, assuming it's a single material scenario. The headers doesn't change. Now, I'll give an example. The company is producing a product. This product requires 4 kg at the rate of rupees 1.5. Okay, and we wanted to produce 4,000 units. This is the information. We wanted to produce 4,000 units, 4 kg at the rate of rupees 1.5. Now, my planning variance will come into picture the moment I change the plan. Now, in reality, what had happened is I had made some changes in my process, because of which I should take 5 kg. Instead of 4 kg, I should start consuming 5 kg. In the market, the things have undergone a change and the price now for this raw material is only 1.1. This is market changes. 5 kg at rupees 1.1. This is the change which has happened in the market. In reality, what I have ended up doing is I have consumed 20,000 kg at rupees 1.2 and the production was 5,500 units. This is the reality. The production is 5,500 units. Now, my original plan was 1.5. My original plan was, okay, let's not make it as 5,500, let's make it as 4,500. My original plan was to buy raw material at the rate of 1.5. In reality, I purchased it at what price? 1.2. I go to the purchase manager, he says, I've done a fantastic job, pay me bonus. Because 1.5 is what you wanted me to buy it and I bought at 1.2. Now, I got a little irritated because I thought in the market people are buying at 1.1. Why is this guy asking for bonus when he has become inefficient? So, that inefficiency will get captured through your planning and operating. Now, when you do planning and operating, SP refers to the original budget of 1.5 and AP refers to the revised budget of 1.1. You have changed your budget. Planning is related to changing the budget to 1.1. When it comes to operating, the standard price is only 1.1. The standard price is 1.1 and the actual price is 1.2. Clear? Then the production manager is not happy. He is thinking that he has not been doing a good job because the original plan was to consume 4 kg per unit. So, for 4,500 units, you should have consumed 18,000 kg. 1 unit 4 kg, 4,500 units, you should consume 18,000 kg. But he has consumed 20,000 kg. So, something has gone wrong is the normal understanding. But no, you have changed your budget and now you have told people to consume how much? 5 kg. So, when it comes to standard quantity is 4 into 4,000. When it is budget, we work with only 4,000 units. Okay, planning variance will always work with only 4,000 units. So, this is 16,000. This is 5 into 4,000, 20,000. SQ refers to original budget, AQ refers to revised budget. SP refers to original price, AQ refers to revised price. When it comes to operating, SP refers to the revised budgeted price, SQ refers to the revised budgeted quantity required to produce your actual output. So, I am not going to copy this 20,000 below here because I have produced 4,500, which means I should consume 22,500 and I have consumed only. The difference between your original budget and revised budget is called as planning variance, and the difference between revised budget and actual is called as operating variance. Planning variance is like market size, not in your control. Operating is like market share, which is in your control. Clear? Any doubts on this? Planning is market size, operating is market share. Clear? Any doubts on this? I'll directly get to the problem. We had done few problems. Let's do question 4 now. The following details show the direct labor requirement for the first 6 batches of a new product. Output 6, labor hours 2400, actual 6 1950. Total labor cost, this is in page 361. Output 6 2400 1950, labor cost. Of the anticipated learning effect. Please go through the question. Okay, now listen, what has happened is we have produced 6 batches and the labor hours is 2400. So first batch should take 400 units, second batch 400, third batch. That is what this guy has done. And there is a huge favorable efficiency variance, 3150 efficiency variance, because we wanted them to spend 2400. Now the production manager said that I had a 90% learning curve. Now taking 90% learning curve into consideration, we will calculate the standard time. That standard time is called as the actual time for the purpose of planning variance, because there is an original budget, there is going to be a revised budget, and there is going to be an actual. So I will need something like this: revised budget, which is 6, the time which you calculate, 6 and the time which you are going to calculate now. So original budget is 2400 hours, there is a revised budget. This revised budget is going to be taken into consideration as the standard for the purpose of operating variance. Able to understand this? The budget itself is wrong. They are saying we made a mistake in the budget, we want to change the budget now. That is what is the requirement of the question. Working note 1, calculation of time to be taken for 6 batches. Calculation of time to be taken for 6 batches. Time to be taken for 6 batches. Time to be taken for 6 batches. Y is equal to ax power b. 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 Y a is, what was the time for the first batch? It is going to be, because what this guy did is he just multiplied 400 into 6 and said 2400, because he did not bring in any concept of a learning curve. So y is equal to 400. Can you just go to the learning curve and tell me what is the learning coefficient for 90%? Let's use that from there. I don't want to calculate that. Minus 0. That is 95%. 90%. Can you just see the question? Some question will have 90% learning coefficient. 152 is what I remember. 322 is for 80%. 0.152. I'm not going to give you any log values. You can keep referring there. Log 2, 3, 6. Somewhere use that and get these numbers. Anti-log alone, I'll tell you the values. Y is equal to 400. 6 power minus 0.152. What is the log 3 value? 0.4 double. Simplify this and tell me. 2.48. 2.4838. Let me know in case there's a doubt here. 2.4838. Log y is equal to 2.4838. 2.4838. $2.4838. Any doubts on this? Now I'll give you the anti-log values. Okay, anti-logs. $4.838. When you look at the anti-log values, you will not look at the number before the decimal. 4.838 is 3041 plus 6. 3041 plus 6, it's 3047. 3041 plus 6, 3047. 3047. 3041 plus 6, 3047. And when should you put a dot? 304.7. 304.7. Any doubts on 304.7? Clear? Can we proceed? Now I'll explain the planning and operating part. Now listen for some time. SR into SH, SR into AH, AR into AH. Then operating SR into SH, SR into AH, AR into AH. Now okay, the original part of the question had said that we will take 16,800 for 2,400 hours, which is 7 per hour. When you are doing planning variance, don't even look into the actual data, because if you look, your starting stage of confusion will happen. 7 is the SR. In anywhere in the question they have talked about saying that the rate has to be changed something. No, then it continues to be 7. It will continue to be 7. Okay, I'll come to the actual variances in some time. SH is 2,400. Which is 400 into 6, which is incorrect. They made a mistake in estimation, and the real number which they have taken is 304.7 into 6. Now listen, if it's a comprehensive problem, you also have sales. So if the budget is for 400 if the budget was for 8 units, then we would have done 304.7 into 8. When it comes below, you will do 304.7 into 6 only, because that is for the actual output. So this part will always be for the budgeted quantity, not the actual output. It is whatever was the budget. They have not given any number on that, so let's not worry about it. Now when it comes to this continues to be 7, and SH now is 304.7 into 6. SH is 304.7 into 6. This is 1950, and the last number is multiplication 13,650. Whatever variances you calculate above, labor cost variance, labor rate, labor efficiency, formula and all is same. It's called as labor cost in bracket planning variance, labor rate in bracket planning variance, labor efficiency in bracket planning variance, labor cost in bracket operating variance, labor rate in bracket operating variance, labor efficiency in bracket. Can you please quickly complete this? Let me know if there's a doubt. Which one? Actual hours basically refers to SH means original budget, AH means revised budget. You understand it like that, or new budget. Original budget and new budget. Original budget was to spend 400 hours per unit. The new budget says it's not 400, it's 304.7 per unit. That is why we have taken AHS 304.7 into 6. SH refers to original budget, AH refers to new budget. Then SH refers to new budget, AH refers to actual. Still there are some favorable variances even on the operating side, but it is not entirely this 3150. What is this number? 16. This is 12,000. 797. Okay, then I think there is going to be an adverse variance on the operating side. 12,797. In fact, there is no favorable variance. Labor efficiency planning is equal to 4,003 favorable. Labor efficiency operating, how much? 8. This is what is more important. The people are responsible for the operating side. You cannot make them responsible for the planning side. So in short, the company has performed bad. The net conclusion is the company has performed bad. They have not performed good. They have ended up wasting time. It is not a favorable scenario. It's in fact an adverse scenario for the company. They ended up wasting time. Okay, I was talking about the extra classes requirement. I'll not have any evening classes. I'll be free in one of the Saturday and Sunday. I'm not sure of the next 3 Saturday, Sundays which are going to come in, not the coming one. 29, 30 or the before one. One of the Saturday, Sunday, whenever I am free, because I'll have my CA inter revision classes. So in between one Saturday, Sunday, I'll be available. In that Saturday, Sunday, my SFM would anyway get over. So I'll be free. In that day, it will be a overall class. Morning 6 to, it may go on till something like 2 or 3 o'clock. 3 o'clock, Saturday as well as Sunday. 2 classes if I keep that way, I think we'll be done. Today standard costing is getting over. So what is left over is only marginal costing and linear programming. So that we will cover through the normal classes on Monday, Wednesday, Friday. Hopefully none of my classes get cancelled because of XYZ reason, whatever it is. So if it goes on in this Monday, Wednesday, Friday mode, bulk of marginal costing will get over in the normal classes itself. Still something is left over that will get captured in that Saturday or Sunday. So no requirement for any evening weekday classes. The classes should get over by September 30. I don't see any extension on that. It will get over before that. If I get that Saturday, Sunday, most probably that Saturday, Sunday can be September 15, 16, whatever is that period, there is one Saturday, Sunday. So that Saturday, Sunday, if I get free, then even our standard cost, even marginal costing bulk can get over and classes can get over even by September 25 types. So we'll see how it progresses, but no classes during weekday. Saturday will not be possible. Okay, Saturday 6 to 9 to anyway you guys will attend. Saturday 6 to 9:30, 10 types I'll keep it. Sunday I'll keep an extended class. Saturday shouldn't be an issue for you guys because some of you used to come for SFM. So SFM is over. So you come for SCM. And for others, I assume Saturday you don't have class. If there is a class, we'll see what is to be done. If at all you have anything extra. Okay, let's move to question 5. T-Tech Limited is a Taiwan-based firm that designs, develops and sells audio equipment. Founded in 1975 by Mr. Boss, firm sells its products throughout the world. T-Tech is best known for its home audio system and speaker, all that is given. Sales 3,000, 5,000, units is 1,500, 500, selling price is given, standard cost. The managing director has sent you a copy of an email he received from the sales manager K. We have had an outstanding month. There was an adverse sales price variance on 3000 WPMPO system. That's a product name, okay? It's not units. 3000 WPMPO systems of rupees 22,50,000. But I compensated that by raising the price of 5,000 WPMPO systems. Unit sales of 3,000 were as expected, but sales of 5,000 were exceptional, and we gave a sales margin volume variance of 23,75,000. I think I deserve a bonus. This is the mail which has come. He has done some analysis and he said that I deserve a bonus. Managing director has asked for your opinion. You got the following information. The total market demand for WPMPO was as budgeted, but as a result of suppliers reducing the price, the total market for 5000 WPMPO raised. The company had sufficient capacity to meet the revised demand. Calculate the following operational variance based on the revised market details. Sales margin mix variance, sales margin volume variance. Comment briefly on the measurement of case performance. Please go through the question. Okay, let's discuss the question and then we'll get to the solution. Solution is a very limited part of the problem. Let's do a discussion. The company, I call it as A and B. So company wanted to sell 1500 units of A at 18,750. They have sold 1500 units at 17,250. I wanted to sell at 18,750. I have sold at 17,250. How much is the fall in price? 1000. It's 1500. Fall in the price is 1500. 1500 into 1500 is how much? There was an adverse sales price variance of 22,50,000. I wanted to sell 500 units of B at 50,000. I have sold what? 600 units at 53,750. So there is going to be some favorable variance on this. This quantity is same, so there is no quantity variance. I am yet to come to planning and operating, normal understanding. In this, I have sold more units, so there is going to be a favorable volume variance. We have sold more units. We have sold it at a higher price, so there is also going to be a favorable price variance. This is what you used to normally do. Now comes the second part of the analysis, which is bringing in the concept of a planning and operating variance, OR, market size and market share variance. Market size is planning variance, market share is operating variance. Now, I have to see whether the budget is right or not. Now, the question will give you certain data points which can say that no, we should not sell 1500 units, we should sell 1200 units. The question can also say we should not sell at 18,750, now we should start selling at 16,000. Anything can happen in the industry. In the interim period, anything can happen in the industry. If something happens in the industry, I have to change the budget. So the budget can be changed for quantity or price. You can undergo a change at any level. If you change the quantity part, that's called as planning variance at a sales margin volume variance in bracket planning. If you change the price, Sales margin price variance in bracket planning. Clear? Any doubts on this? Anybody has any doubts on this? Now, the industry has told this. Demand for product A is same. So, no change in quantity of product A. No change in price of product A, because they have not given any details on the price change in the industry. We have sold at more, we have sold at less is operating variance. But as a result of suppliers reducing the price of supporting UHD TV system, the total market for 5,000, total market for product B is raised by what? 50%. So I should not be selling 500 units, I should be selling, and what did I sell? So it's going to be an inefficient work. It's not going to be an efficient. He has just said that, great, pay me a bonus now. He just said that, I've done great job, why don't you pay me bonus? Price, favorable price variance, adverse price variance I've compensated, but on the quantity side I've sold more, you have to pay me bonus. Clear? Any doubts on this? Any doubts on this part? Working note 1, calculation of planning variance. They have not asked for planning, they have asked only for operating, but we'll do both. Calculation of planning variance. I'll have to do the margin approach. BM into BQ, BM into AQ, AM into AQ, BM into BQ, BM into AQ, AM into AQ. Yeah. Which one? The question has said somewhere. Sales margin, mix variance, sales margin, volume variance. Otherwise, you can do any of that. That doesn't matter. BM into BQ, BM into AQ, AM into AQ. I'm not bringing in RBQ. RBQ will help me in calculating the mix and the quantity variance, which is not asked in the question. So we will just do the volume part. Now, the two products which are there is 3000 W and whatever 3000 W PMPO, 5000 W PMPO. You can just mention whatever name they have given. Those are the two products, 3000 W PMPO, 5000 W PMPO. Now listen, you should never look into actual data when I'm doing planning variance. The moment you look into actual data, you will make your first mistake. So don't look into actual data when you are doing your planning variance. How many units we wanted to sell? 1500 and 500. 1500 and 500. What is the margin at which we wanted to sell? 6250, 23, 750. Any doubts on this? Budgeted margin into budgeted quantity. Budget refers to original budget, actual refers to new budget. I'll use the word new, not the revised. We'll use the word new budget. Now listen, I'll take you through. As I say, you keep noting down. Any doubts till now? When it comes to this BM, I copy paste. Is there any change in the industry size for product A? No, so we will continue to sell 1500. We will continue to sell 1500. Any change in industry size for product B? It has grown by what percentage? 50%, so this should become 750. 1500 will continue to be 1500, but second product I should sell 750. Any doubts on this? We should sell 750 units. Any doubts on this? Okay, then comes AM into AQ. Now listen, AM refers to new price minus budgeted cost. Sometimes cost can change. That cost change will not come in sales planning variance. The cost change will go to your respective material variance, labor variance and variable overhead. So any change in the price, No, don't look into the actual. Any change in the price, the question will say that the government has given a tax benefit and because of which the prices have fallen to 20,000. If prices have fallen, you'll have to work with that price. You cannot work with the earlier price now. So this remains same, 6250, 23750 into 1500 into 750. You'll have only one variance after doing all this. Just compare these two. Sorry, not these two, sorry. Sales margin volume variance in bracket planning for 5000 W PMPO. They have been doing separately for the product. I don't have any other variance, okay, for 5000 W PMPO. 23,750 into 500 minus 23,750 into 750. Pause, you will get a negative answer which means favorable variance. Negative answer which indicates a favorable variance. 50. So the industry has given a benefit of 59 lakh rupees to us now. The industry itself has made us to increase our profits by 59,37,500. This is not our job. So I cannot be saying the salesman, you have done an excellent job because you are made more profits. This is the industry component. This is not for which I can penalize the salesperson and I can reward him, because sometimes what will happen is the industry can shrink. Like industry grows, industry can also shrink. From 500 it shrinks to 200 units and this guy sells 300 units. So you will have to appreciate him. You cannot be penalizing him because saying that you wanted to sell 500 units, you have sold only 300. Whereas the industry has shrunk to 200 and this guy has sold 3. The revised industry size for us. Any doubts in this? Clear? Can we proceed? Then operating variance. Operating variance. Operating variance. Again, BM into BQ, BM into AQ, AM into AQ, BM into BQ, BM into AQ, AM into AQ. BM into BQ, BM into AQ, AM into AQ. In the side, 3000 W PMPO and 5000 W PMPO, 3000 W PMPO and 5000 W PMPO, which is 6250 23750. I'm not explaining in detail. In case you need some guidance, please let me know. We have done this at multiple places. By now, the entire standard costing, you should have a grip about it. I'll be uploading mostly your entire lectures of standard costing in YouTube. So the moment I upload, I'll let you know. I think everything has come out properly. So if there are no gaps in any of the lectures, the entire part will go into YouTube. So you can revise with that also. 6250 and 23750. 6250 23750. BM is 6250, AM is BM 6250 23750. What is the AM? 17250 minus 12500, which is 4750, and 53750 minus 26250, 27. Any operating variance, the person is responsible. Any planning variance, the person is not responsible. I will not reward him as well as I will not penalize him. 1500. Sales margin mix variance operational 3000 WPMPU. Sales margin price variance operational 3000 WPMPU and 5000 WPMPU. 3000 WPMPU and 5000 WPMPU. Three thousand WPMPU is 22 lakh. Again, I think this is also 22 lakh 50,000. Both are 22 lakh 50,000. One is adverse, the second one is favorable. Sales margin price variance operating 22 lakh 50,000 adverse and 22 lakh 50,000 adverse. Sorry, favorable. They've asked, no? They've asked mix. Mix wouldn't make any sense in this question. I'll just check the question. You keep doing it. I'll just check the question. Is it mix? Let me just check it. Mix means we'll have to bring RBQ in between. Wouldn't make any sense, but okay, they've asked only mix only. We had to do the mixed variance only. Sorry about it. Mixed variance means you'll have to bring in between RBQ. I missed it out. The requirement of the question is mixed variance only. Listen, just for a minute, nothing much to be done. In between an item will come called as BM into RBQ, 1500 and 600 split in the ratio of 2:1. 1500 and 600 split in the ratio of 2:1. 1500 and 600 split in the ratio of 2:1. $1,400 sorry 23,750 into 700. 6250 into 1400, 23,750 into 700. Into 1400 into 700. In between RBQ will come, my mistake. I thought they have asked for only price variance. I'll just take you through the answer. Maybe there is some sort of confusion. Is this table fine? Any doubts on the table? Anybody has any doubts on the table? Now come down, right? Sales margin mix variance. Sales margin mix variance in bracket operating. Sales margin mix variance in bracket operating. Let's first write the formula. BM into RBQ minus BM AQ. BM into RBQ minus BM into AQ. All these formula I had earlier explained what is to be done. BM into RBQ minus BM into AQ. 3000 W PMPO. 3000 W PMPO. 3000 W PMPO. The BM for this was 6250 into 1400 minus 6250, 1400 and 1500. 6250 into 1400 minus 6250 into 1500. Sales margin mix variance 6250 into 1400 minus 6250 into 1500. What number do you get? 6,25,000 favorable. Then 5,000 W PMPO is equal to, what was the number? 23,750 into 700. 23,750 into 600. Complete this and then do volume variance. 6,25,000 favorable. The other one is 23 lakh. 2375 adverse. When it comes to volume variance, it is BM into BQ minus BM into AQ. Volume is BM into BQ minus BM into AQ. Nothing for 3000 WPMPO. BM sales margin volume variance in bracket operating. Below that 3000 WPMPO 0. 5000 WPMPO is most of you look blank. I'm not sure whether you know the formula, not know the formula. What is the formula for your sales margin volume variance? BM into BQ minus BM into AQ. 3000 WPMPO is 0. 5000 WPMPO is 23,750 into 750 minus 23,750 into 600. You get a final answer of. Okay, this is the answer. I would like to discuss the second part, which is more critical. 3562 500. Clear? Now the question says, the question's requirement is comment briefly on the measurement of the case performance. So this person K is no, he is saying why don't you pay me bonus, because I got a favorable volume variance of 23,75,000. It's not favorable volume of 23,75,000, it is adverse. What was the adverse number? 35 lakh something you were saying, no? 3562 500. Why it is 2375? You had a huge favorable volume variance, some 53 lakh some number, 56 lakh or some number. There was a favorable, what was the planning variance? Sales margin volume variance. How much? Okay, 59, 37, 500. That was the planning part. Operating part was negative how much? 3562 500. So one we have a negative part of 3562 500 and one we had a positive part of some number. Because of this negative 3562 500, I am not going to pay any bonus to this person because he doesn't deserve any bonus. That is anyway a negative component of 3562 500. So we are not going to pay any bonus. When you write, you will have to explain this. So I'll just show you what they are mentioning here. A planning variance simply compares a revised standard to the original standard. A planning variance is considered as not to be controllable by management. However, variances caused by change in, okay, I'll talk about the most important part. This is the most important part. The favorable volume variance of 23,75,000 referred in case email is made up of two elements. One of which is the market size is a planning variance which is outside his control. It is this that has caused the overall volume variance, and thus K is not responsible for the overall favorable performance. He is not the person who has contributed to the favorable performance and he is not going to get any bonus. Clear? Any doubts in this? Because till now we learned only overall variances. Why planning and operating is critical is planning is beyond my control. You told me to complete a task in or buy a product in 20 rupees. Market the price has increased to 30. Now you have to change the budget to 30 and I buy it at 28, which means I have done a good job. You should appreciate me for buying it at 28 rather than penalizing, saying that you bought at 8 rupees extra. Clear? Any doubts in this? Let's move to the last question. Go through question 6. Please go through question 6. Okay, let's try to understand the question first. They have given the details of a company and a budget is given. Budget is for 6,000 units, actual is for 5,400 units, and there's a variance of 600. The management accountant and APC has realized that the size of the fast food market that was used to derive the budget number of meals to be sold has been overestimated. He made a mistake in doing the estimation. Management accountant has calculated the value of sales volume contribution planning variance. Basically, sales margin volume variance based on marginal costing is 2480 adverse. So, prepare a revised budget based on the new estimate of the market. Now, I'll have to use this 2480 adverse and find out what should be my new budget. It can't be 6,000. It's going to be lesser than that. Could be 4,000, 5,000, whatever be the number, I'll have to do a calculation of that. So, let's start. Sales volume contribution planning variance equal to sales volume contribution planning variance equal to volume contribution planning variance equal to BM into BQ minus BM into AQ. The formula doesn't change. BM into BQ minus BM into AQ. Now listen, what changes is, formula never changes, but BQ refers to budget quantity and AQ refers to new budget quantity. BQ refers to your original budget quantity and AQ refers to your new. How much is the variance? Adverse means it's positive for us. 2480 is equal to, adverse is a positive scenario for us in sales variance. 2480 is equal to, leave some 4 lines, BM equal to budgeted price minus budgeted variable cost. Budgeted price minus budgeted variable cost. Look at that budget and tell me these two numbers. Budgeted price minus budgeted variable cost. Contribution means you'll have to do marginal costing. That's very clear. Budgeted price minus budgeted variable cost. What's the budgeted price? 7.5. Budgeted variable cost 4. 7.5 minus 4.4. minus 4.4, it is 3.1. 7.5 minus 4.4, it's going to be 3.1. 3.1, what was the original budget? 6,000 minus 3.1 AQ. This AQ refers to the new budget. Tell me what should be the AQ figure, which is the new budget. AQ refers to the new budget. 5,000? Okay. The budget is wrong. I should not be having 6,000 as the budget. The budget is only 5,200. In fact, on the sales side, it means I have done a good job. On the sales side, it's a good performance by me because it's only 5,200. Any doubts in this? Next working note, revised budget and performance report. Revised budget and performance report. We will prepare the performance report in the way they have prepared it. Revised budget and performance report. Listen for a minute. Just listen for a minute. It's going to be exactly this only. Sales, revenue, variable cost, fixed cost, profit. Just that this has to be 200. This has to be, sorry. Okay, I cannot combine the reports. Okay, first we'll do the budget only for 5200. Sorry about it. Let's do only the budget. Revised budget for 5200. Revised budget for 5200 units. Particulars. Amount. Particulars and amount. Particulars and amount. Units to be sold. Particulars and amount. Units to be sold. How many units are to be sold? 5200. Units to be sold 5200. Revenues 5200 into 7.5. Variable cost 5200 into 4.4. Fixed cost 5250 and profit is 10,870. Any doubts on this? Now, they have given this performance report in this format. I am not sure whether this is what is required. I need to check the answer. But if I prepare in this format which the management wants, this is not the right analysis. Why it's not the right analysis is, you are comparing 6,000 variable cost with 5,400. If you compare it that way and then tell the conclusion saying that we have spent more, the last column, variance. It is not there is a favorable variable cost variance because you compared 6,000 cost with 5,400 cost. So if this is the format they need, we may end up preparing it in the same format, but let's do it in variance analysis itself. That makes more sense. Next, calculation of variable cost variance and fixed cost variance. Calculation of variable cost variance and fixed cost variance. Calculation of variable cost variance and fixed cost variance. Variable cost variance equal to standard variable cost minus actual variable cost. Standard variable cost minus actual variable cost. Standard variable cost minus actual variable cost. Standard variable cost is 4.4 into how many units did we actually sell? 4.4 into 5,400 minus 24. Do this and tell me what is it. 4.4 into 5,400 is what I should have spent, and I've spent 24,632. 8 and the question talks about a favorable scenario, whereas it's an adverse scenario. I cannot compare 6,000 ka cost with 5,400. 872 adverse. So on the cost side we have lost money. 872 adverse. Any doubts on this? Clear? Fixed overhead cost variance is very simple. BFOH. We are following marginal costing. In marginal costing only expenditure variance will come. BFOH minus AFOH. What we budgeted as compared to what we have spent. BFOH minus AFOH. BFOH is how much? 5250. $300 favorable. This is right what they have given, but the variable cost was not the right number. Any doubts on this? Anybody has any doubts on this? Clear? Can you proceed? Then calculation of sales variance. Calculation of sales variances. BM into BQ. I have the price and all, so I can calculate it. BM into BQ, BM into AQ, AM into AQ. BM into BQ, BM into AQ, AM into AQ. What is the price at, sorry, what is the quantity we want to sell now? 5,200, and we have sold, we want to sell 5,200, we ended up selling 5,400. Want to sell 5,200, we have sold 5,400. BM is you calculate AM, actual price minus budgeted variable cost. AM is actual price minus budgeted variable cost. How much is the AM? It's in decimals. Is there rounding off happening? Okay, 3.075 then. 3.075. Your actual price is 4365 by 5,400 minus 4.4. 4365 minus the 4.4 number. Sales margin volume variance is 620. Sales margin price variance is 135. Any doubts on this? Clear? Any doubts on the 620 and 135? Next, performance report. I'll take you through the entire one. Performance report. Performance report is nothing but we are doing a reconciliation. Performance report, particulars and amount. Particulars and amount. Particulars and amount. Now, let's start with budgeted profit as given in the question. What was the number given in the question? 13,350. Budgeted profit is 13,350. Now listen, this is what, listen for some time, I'll tell you to note it down. This is what we wanted to earn. Now what will happen is less sales volume planning variance. What was the planning variance part? 2480. So once the market size re-estimation happened, this is my revised budgeted profit. It's not standard profit, it's revised budgeted profit, and this number will match with what we had written here, 10,870. Revised budgeted profit 10,870. Then add fixed cost variance, add sales margin volume variance less variable cost variance less sales margin price variance, and you will get the actual profit as given in the question. And you will get the actual profit as given in the question. Please do it. We had a budget of 13,350, but the industry has shrunk. So my revised target is only $10,870. From 13,350, I have revised my target downwards to 10,870. The target got revised downwards to 10,870. Fixed cost variance was 300, 620 minus 135. Variable cost was how much? 872. 10,783. This is what is a meaningful analysis, because variance is this, not what you compare 6,000 and 5,400 and write a variance. Any doubts on this? Okay, the problem is almost over. I just want to discuss that balance part. Just 2 minutes, we'll discuss that and end the session. Any doubts on this? 10,783. Clear? Okay. Explain two non-financial measures that APZ could use to monitor the performance of the new fast food restaurant. So how will you measure it? You would tell me a way to measure it also. In a non-financial measure, there should be a way to measure it. So what will you write? Customer? Okay, one can be a customer rating. I'll tell to customer to rate my service. I think it is more related to this is a Small number of long is business and attractive. Quick food service, so maybe time taken to deliver the product or deliver the time taken to serve the food. This could be one of the parameter which I can use to assess how my performance is improving and also the feedback rating from my customers. Clear? We'll end with this. We'll do marginal costing in next session.